All right, let's just get it going. Let's just get it going here. Welcome to Wall Street Beats. I'm Benjamin Bry, joined by the Robert and Robert, but Bob and Robert combo. We are February 20th. Let's get it going today, guys. Let's start with Bob because we were just talking in the pre-show about oil. We got $66, $67 oil. Seems like a long time since we've been up here. Bob, how much money, how many dollars of this is event risk? You know, what is the play for the next month, or how does it play out, I guess, is the question.
Sure. So it is headline risk. And at this point, we probably got $6, $7, $8 per barrel of geopolitical premium in the price of oil. And we've moved up $3 or $4 this week alone from when we were on Monday, and then said there was $3 to $5 per barrel of geopolitical premium in it, and it's moved up on these tensions with Iran. And it's Friday. Nobody wants to go into the weekend short crude oil, not knowing whether or not Trump's going to pull the trigger on Iran or what the outcome is going to be. He came out yesterday and said they'd make a decision within 10 days probably as to whether or not they invaded Iran or not. And they're at the table trying to reach some agreement, but we all know how Iran plays games and dig their heels in, and they're going to fight, not try to give in on their nuclear enrichment program. And it appears that they're already in the process of rebuilding it. So, it's hard to handicap the odds of what happens here. I was looking at Polymarket, not that I use that as a key investment tool, but basically the odds are 50-50 that the U.S. strikes Iran by March 15th. And some of the, talk is out there that maybe it's a lighter or limited attack to begin with. And if they still don't come to the table and give in on the demands from the U.S., then there's a second wave that's a much heavier strike. And so we're just waiting to see what happens here. And, again, it's hard to put odds on it. Odds are basically 50-50 that the U.S. invades. But in the meantime, oil's holding up here. And it's going to continue until we see some resolution, until we know which way this breaks. Oil's going to continue to hold up here. And I think people look at oil prices and say that the risk is skewed more to the upside than the downside, even after this $5, $6 per barrel move. In the meantime, the peace talks between Russia and Ukraine broke down this week. So again, another factor that, contributes to that geopolitical premium in the price of oil. The one thing at $66 oil, these companies are making very good money. And a lot of these companies are probably locking in hedges or trying to lock in some of this move up in the oil price right now as we go through the year. So this is all positive for the energy stocks. Energy is sort of it's had a bid here. It's the best performing sector year to date. It's still only 3% of the S&P. So you don't have to put a lot of money out of tech or wherever you want to pull it into energy to make this sector move. So we're sticking with the names that we own here. Obviously we've had big moves in all these names that we like, whether it's C&Q, EOG, Chevron, Exxon, all these names have done well. And they're going to be volatile depending on what the oil price does. But I'm sticking with them here. And, I'm not making any changes here. I talked a little bit Monday, maybe writing out of the money covered calls and maybe 10% of my position in C&Q, but I'm holding off. I mean, I'm just waiting and watching here just because I like the valuations where oil prices are here today. In the meantime, just apart from oil prices, we had our two gas-focused names in the E&P sector report earlier this week, Expand Energy and EQT. I was actually a little bit more encouraged with EQT's results than Expand, even though Expand's been my favorite name over EQT year to date. But the one thing that's occurring with Expand Energy, as we talked about last week, is that the CEO resigned abruptly, and the company announced they're moving their headquarters to Houston. And as we talked about last week on the call, they sort of confirmed this week that, they're wanting to be more aggressive in being involved in the downstream aspect of the business, or what they call the value chain, or downstream of the wellhead. So that clearly, as we speculated or talked about, was the difference, I think, between the board and the CEO, Nick Dell'Osso, who I liked a lot. And it appears that the board is pushing more for the company to do more downstream. They said it's not M&A, although I'm skeptical that it's not M&A. They said they were looking more for partnerships downstream, which I'm a little nervous about. I like the fact that the company's almost a pure play natural gas company. I like that leverage in natural gas. and being able to play it on that pure leveraged natural gas. Granted, it's a good strategy if you can capture better realizations in your gas price by participating in the downstream part of it through partnerships. But I don't want them to dilute or deleverage, so to speak, some of that leveraged gas prices in doing so if they were to make a downstream acquisition of a midstream company. At the same time, they're talking about being more in the liquid side of it. So are they going to go out and buy assets that have more of a liquids mix to it? And again, that comes with risk and what price you pay. So they said it's going to take 6 to 9 months to find a new CEO. So, a little bit of shine off the rose, so to speak, a little bit in that regard. And a little bit unsure and nervous about how this plays out with the new CEO and how the company's run in the interim with the interim CEO. And listening to him on the call, I still like the name, but we're watching it closely here. It sort of came away from things more favoring EQT over Expand Energy here at this stage. But I like both names. I'm sticking with both of them. I'm not selling, and if we were to get a sharp pullback for whatever reason, I'd probably add to one or the other, but not doing anything with either one right now. Still like both names on this whole long-term play on natural gas.
Let me push you a little bit on the oil price.
You have to like it on a long-term play on natural gas because short-term it sucks. It's got a 2 handle, 2.99 I saw this morning in the pre-market. Now,
it's warming up. It's raining
welcome
here.
Welcome to the show, grumpy Robert. Welcome to the show.
$2.99, come on. $2.99, come on. That's giving it away.
It was raining out today because it's warm.
And by the way,
if it were cold outside, it'd get heavy snow, but we're not. Winter's over with, Robert. I mean, we've sort of thrown in the towel on winter. We're past the midpoint of February. It's going to be springtime here in a couple months, so we sort of put winter into the books. And it's been colder than normal, 5% colder than normal, and here we are, like you pointed out, at $3. So, and we're heading into the shoulder period. So, near term, that's what happens. You've got storage levels only a little bit below a year ago, heading into the shoulder period where demand wanes until we get into the summer.
On the positive, the inventory is below where it was last year, and it is below the 5-year average, and demand is well above the 5-year average. So, as a percent of demand, it's actually, I think we're well positioned in inventory going into the shoulder season. And now we need obviously a hot summer. But I also noticed today on natural gas intelligence, I woke up at 3 a.m. and couldn't sleep, so I was perusing the internet, that I think yesterday Europe announced their February end natural gas inventories, and they were at a 9-year low. They said they haven't been as low in absolute sense since 2018. And obviously I don't know this because who knows what Europe does with hydrocarbons, but I would assume natural gas demand is higher today than 10 years ago. And on an absolute basis, if inventories are low, that should at least support LNG exports into Europe over the spring and summer for sure. So that's that's a positive. And I think the strip, I Googled the strip last night. I still think it's a high 3 for the next 12 months, and it's a 4 handle for 2027, I believe.
Yeah, I mean, that LNG impact you mentioned there, the demand there, if something happens with Iran and there's some interruption into the Strait of Hormuz, that's where a lot of the Qatar and Saudi Arabia LNG exports flow through. So that then becomes more of a positive for U.S. LNG demand in U.S. natural gas prices in that sense. But yes, Europe is way low on their storage levels here coming out of their winter. So that's, again, if we have a disruption in the Strait of Hormuz because of some conflict with Iran, that's not only positive for oil prices, that flows through and is positive for natural gas prices indirectly here in the U.S., given that LNG impact.
Yep.
So. Let me push you on the oil price a little bit because it is topical. It feels weird to have it in the high 60s. We've gotten used to just, no bid. If we get no, let's say Trump does his traditional taco thing, is like, because he doesn't like war, to be fair to the guy. And he comes up with something, and there's a resolution or a perceived quasi resolution Are we going back to 58.60? And then on the other side, if this escalates, where's the levels there as well? Like, the Strait of Hormuz is the worst one, and then just a normal, like, just attack. Just give us a kind of a range of pivot levels, if you will, on this event in your mind.
So you said it feels weird, but if we go back to June of last year, we were at $75 a barrel last June.
Yep.
So it's not that weird in that regard. But the one thing we were thinking about here too is that every time there's some sort of military action or perceived disruption in supply routes or supply itself in the Middle East because of an attack or war, it seems that oil always spikes up and then comes right back down, because then the market says, okay, that happened, but now everything's going to be sort of washed out and flows will get back to normal and things will be fine. Would that be the case here or not? We don't know. But I think the upside is $75 a barrel. If we go through the weekend and Trump decides to pull the trigger and send missiles into Iran in a limited attack, just saying, look, this is what we're going to do, just as a taste of what we can do. We're going to shoot a bunch of missiles, hit those nuclear sites again. And look, this is your shot across the bow. Now you really need to come to the table, or we're going to come in again, and next time it's going to be brutal. So, I think the upside, if there is some firing of missiles, if Iran, it doesn't look like it's going to come to the table, if there's not going to be any resolution, I think we could quickly go to $75 a barrel. Now, as you pointed out, the downside, what we talked about earlier, is if peace breaks out. We always say if peace breaks out, we get something with Russia and Ukraine. Iran says, you know what, and I think the unlikely case this happens anytime soon, but they said, you know what, we'll cry uncle and we'll stop all our uranium enrichment. Despite the fact in the meantime, right now today, they're trying to rebuild it all. We'll go ahead and stop. When you've scared us enough that we're not going to do anything, then yeah, oil could go right back down to 60. But I don't think that's likely near term. I don't think that's in the cards near term. And again, I think the risk is, even though we've moved up $6 a barrel here in a very short period of time, I still think the risk is skewed to the upside than the downside, given I don't think there's going to be any immediate resolution to these conflicts, either between the U.S. and Iran and between Russia and Ukraine.
Would you sell puts here? Vol's up a little bit. Would you sell like some $58, $60 puts? I mean, I know you're kind of structurally bullish oil. I mean, is that something that you would consider?
I mean, it's not something I typically do.
Okay.
As far as the commodity puts on the commodity, I'd have to think that through. I've never played it that way. I play it through the equities.
Okay. I'm just thinking about the fact that there's a binary, like when you look at the price, it's binary right now, right? There's a binary outcomes. And so the price is not a real price. It's a price that's an aggregation of probabilities on what the perceived probability of these future events are. And volatility has to rise in these kind of scenarios. So if you're structurally bullish oil, that's why I asked that question. I'm not trying to push you to start selling puts on oil futures as much as I'm just theoretically thinking it through.
I mean, you mentioned $50 strike on a put. I mean, is oil go below 58 near term? I don't think it does. So even if oil pulls back,
that's kind of my point.
Yeah, that premium runs up in the meantime. Once you get to the expiration date, you're probably in the money.
That's kind of what I'm saying. And like, would you really have a problem getting delivered at 58? Probably not. And one last thing, Bob, I see our Schlumberger is at 51.50 today. I think Schlumberger is a beneficiary on this. Yeah. Dude, I'm loving it. I haven't been in the oil services game in so long. It's like, it reminds me of buying energy in 2020, where it's just like, oh man, here we go. Like, I mean, now Schlumberger is not the same as buying energy in 2020. That was like absolute, bargain town, Robert Marston land, where we were buying ET at $5, right, Robert?
I waited till 8. I paid 8 3/4 for my first. So.
All right, yeah. I was bid at $5. But yeah, Schlumberger should be a beneficiary in a regime shift scenario, though, right?
Right. Right. And we bought some, that's the only service name we own is Schlumberger. The other name I'd mention too is Occidental Petroleum reported yesterday, and they beat on the earnings, and their name we mentioned Monday. If oil prices continue to rise, they're one of the more levered names to higher oil prices. So that's a name that if you're playing it from the equity side, betting on higher oil prices, it's a name that even though we don't own it, we haven't recommended it, it's a name that's levered to that upside after a beat on the quarter if you want to play it through the equity side on the upside, the oil prices. The other names we mentioned Monday were Apache and C&Q as far as leverage to higher oil prices.
Yep. So I think that we have a good grip on that. It's an interesting thing to be watching. And one thing I would just add as a caveat for people is that I think that the oil price suppression over the last year plus, especially since the Liberation rally, has been one of the big, what I call the horsemen of the three horsemen, four horsemen of the rally. You had volatility suppression, dollar suppression, and oil suppression. And recently we've had all three going the other way, which is why my, canary in the coal mine, red flag, red alert, whatever you want to call it, on just general risk is high as it's been in a long time. Under the surface, we all know that there's been a lot of vol, but let's see what happens. But I think oil going to $75, $80 is a big negative for the market. I mean, right. good for Schlumberger, but bad for the broad market.
And as you pointed out, the one thing that Trump wants very, very much is lower energy prices going into the midterms later this year.
Yeah.
So
yeah,
even though he may pull the trigger on Iran, he wants to get that settled very quickly and get the oil price back down.
Yeah, I think that's the right way to think about it, is that he has a midterm coming. He's got a lot of heat. He's been losing popularity. So how popular will a protracted war in Iran really be right now? And I think that's the calculus you got to do in your head if you're going to make any bets based on some event, which I don't personally do. But I think it's worthwhile talking since the oil is so important. Bob's the man on oil. So anything else, Bob? Otherwise, we're going to move to our favorite Philadelphia Eagles fan, the Philly.
On to the Philly.
All right, buddy. I actually
Philly special. Sorry.
Philly special. I actually wanted to spend some time on my energy sector because there's been a change in mindset in my brain. And, everybody knows I've talked about the MLPs, probably 5 times, if not more, maybe 10 in the last year, various natural gas pipeline MLPs that I own in my income portfolio. We've talked about energy, transfer, enterprise products, Plains All America, and MPLX, the Marathon's midstream business. So they're 4 of the 5 stocks I have in my portfolio. They all had done well in the first quarter last year. Early got caught because of the natural gas and energy story for data centers. They got caught in the tariff tantrum, and they got beat up. Mostly because it's more retail oriented. I think retail panicked more than institutions last year. And PAA was 20, it went down to 16 in the first quarter of last year. I've mentioned it Plains multiple times as a buy because it had a $1.50 yield in my forecast, and then a $1.70 yield for next year. So I always mention you could buy 10% yield with very strong coverage. So all of the it's rallied to 21 now, so it's back at a 52-week high, multi-year high. It's still the dividends going from 16 to 20 for a pipeline and an MLP is a significant move. So I had mentioned during the year that I expected this sector to have another move up when it appeared the move on the next easing cycle was happening. It's not so certain that we're having an easing cycle because the economy seems to be okay so far, hanging on. There's a lot of artificial stimulus in the system right now with the budget deficit and the data center build out, which might be very uneconomic. We don't know. And there's a lot of debt being thrown at that. So, I'm in a position now where I think, you have a shot at getting lower rates. That's starting to be priced into these stocks. When you could have bought a 9 or 10% yield right now, it's 7 to 8, and some of the higher quality ones are 6 and change. So I have gone from a buy mode to a hold mode. I'm not selling. I'll probably be a bad seller of my MLPs because I probably will pass them on to my kids through my estate. It's just that the tax basis is low. The cost base is actually low, and then when you get return of capital to avoid taxation, you lower your basis every year with your distribution. So I would expect my distribution to probably go negative. Excuse me, my cost basis to go negative on these at some point in the next 5 to 10 years. So I'm not going to be buying and selling them and be able to sell that, but I do want to let people know that they've had a nice run. They've done what I expected them to do from their sell-offs last year. They had a terrible year last year. They were the worst performing part of the stock market for me. But now that they've recovered, they've become fairly valued. And I've gone from buying dips to being holders right now of all my MLPs. On a more exciting subject, Ceragon, my 5G telecom equipment company, announced numbers. It was in line. They guided, to a year that's 10 to 15% organic revenue growth after having a 13% down year last year, which was a major pooch. We round tripped the stock to roughly 230, 240 to 550 to 230. And hopefully that's a typical miss for me, is getting a little bit of a first move up and then losing it if they poop the bed on bad fundamentals. SimilarWeb didn't work out that way, but that's one of the few times I wait for a big decline and then get another big decline. If I didn't own SimilarWeb, I would most definitely buy a lottery size ticket at 2 and change or 3. It's up quite a bit today, but it went from 17 to $2.25 in the last 18 months. So it's now back to around $3. Anyway, Ceragon is in line. I'm a holder. I think there's going to be a payoff this year. It's been a disappointment. I've owned it 2 years in a bull market and broke even on my money. But I believe that there's a big reason to expect capacity, requirements for AI and data at the edge, not at the data center, but out in the real world where all the sensing is done and the decision making is done to run machines and analyze events in real time from sensors. So I believe that's going to cause an investment cycle. It's not obvious yet. We've been in about a 3-year down cycle for 5G capital spending. It's been a terrible business. It's been a flop as a technology. 5G has been crap, to be honest, around the world. There's an actual saying that you want to only invest in the even number G upgrades. So maybe this thing waits for the 5G CapEx cycle has fizzled and 6G is going to be a boom. But that's not till 2030, I believe. So it's a long time to wait, 2029. But, if we get a capital spending cycle for AI, and these guys have a massive technological advantage in their products today, because they invested in semiconductors that the industry they compete with is using 11-year-old modem chips. And they have a 1-year-old system. It's not even a modem chip. It's a SoC. So it's a combination, and it's much more efficient and much cheaper per capacity of throughput. So if you could put together a very compelling new product cycle, a little bit of a bump in the capital spending cycle from edge AI demand, I think we could see a doubling to a tripling of the stock again. It doubled for us once, and even though I didn't take any chips off the table, I would expect to get a second bite at the apple to double in the next 12 months. So I'm giving them another 4 quarters, despite poor execution and a poor fundamental industry background that they've had to suffer through for the last couple of years.
I don't know why you do this to yourself with all these telecoms. They talk about suffering. It's just suffering to look at telecoms. It's just such a boring,
I told you that you heard the
awful
Calix
business.
You heard the Calix story before. No? Calix, I bought it 5 with a new product cycle. It was half of sales. It's 25% of sales. sold it at 8 or 9 and 10 because they blew for 6 straight quarters. Then their new product cycle, which was delayed by a year and a half, hit. And I shorted it at 80 2 years after that. It was very painful shorting something at 80. You freaking sold it at 8, 2 to 3 years before that. So I'm looking.
Yeah, that sounds like a personal problem. Sounds like a personal problem, Robert.
I'm looking for a similar type of outcome here. Not a 10x. I'm hoping a 3 or 4x.
All right. Well, that's kind of how you play. You're the right tail convexity guy who buys for 50 to 70 cents a downside to make $3 to $8 of upside.
There's been a lot of 2, 3, 4, 5xers that I've talked about on this show. And there's risk in them too. As you can see, I take 50% haircuts when I'm wrong. There's no doubt about it. But you can only lose 100%. You can make 2, 3, 4, 500%. And if you can hit if you can hit 2/3 of the time, Ben, that's a pretty good investment philosophy.
Absolutely. No, look, from just a math standpoint, you're like a 35 call delta call buyer. And it's not a bad strategy if you're good at picking the right ones, because it gets bigger as it goes, and you can only risk $100 or $1 to make $3 to $5 over time. That works. And you like to pick beat up stocks, so you already have, incorporated some bad news. So it has to be extra bad, right, in order to realize that downside.
And it has to be cheap. I'm buying broken growth stories that I think are fixable, and I'm looking for 10, 20, 30% growth, and I'm trying to buy it at 1 and 1.5, 2 times sales. I'm not buying the obvious growth at 5 times sales or 10 times sales or 20 times sales. That's nuts by my book. So I have a very small universe of stocks that ever fit my buy model because the growth rates are so high, the valuations are so low. There's definitely near-term hair that needs to be reconciled. And I hope to be reconciled in my favor 2 out of 3 times. So when I bought, Spire or Arteris or names like that, I was early. They went down 20, 30% after I bought them, but I ended up making 3, 4, 5 times in a year or 2 years on both of them. So.
Well, I don't think anybody's going to accuse you of being a bad stock picker, Robert. And just one last thing to bow tie this. ET back in 19, boys. It's
back in 19. You could have bought it at 16 a few months ago. In December.
You could have actually. That was a nice time to buy. But I'm just looking at the 5-year chart since COVID. I mean, it's just what a solid stock chart. Just up and to the right, nice distributions. I mean, the reality is with the taxable base going down like that, it's just a gift to Americans. Foreigners can't really own these things, these MLPs. The whole MLP structure is just a gift to Americans. And it's surprising that they're not more popular. I don't know if it's that people like to trade or they're impatient or they just hate energy or whatever, but man, EPD and ET to me is as good as it gets.
I would hope they still have another 10 or 20% as they grow their distributions in the next year, but you won't get the 30% total returns you've gotten off the last year's lows. That's for sure.
Of course, but I'm just saying that, like, in my long portfolio, there's 2 things that I personally, and you guys know I like to trade, and I trade derivatives and weird stuff, but gold and ET. I don't even think about it. I don't think about selling. There's nothing that's going to make me think about selling gold or ET. Like, unless there was some kind of legal thing with ET and Kelsey all of a sudden did some weird shit like he did in 16 again. But like, other than that, and there's nothing that would make me think about selling my gold. So, it's nice to have a few of those things where you can really feel good about what there is. And I think EPD and ET are 2 of them. And I'm surrounded by my 2 favorite guys because we're the only guys who talk about energy on this show. So our producer always likes to put us together, and somehow we always talk about energy, which is nice. All right, guys, you got anything else today, or should we call it there?
Oh, Ben, I don't know if I'm sure you saw it come across the tape. The Supreme Court struck down most of Trump's tariffs.
I didn't see it.
Yeah.
The vol's
Yeah, I
coming
just
down
saw.
on
I
that.
put
The market bounced a little bit on that. It really doesn't have any impact on energy for the most part. But I don't know, you're the volatility guy, what you're thinking with vol coming down on that announcement, or what you're thinking since you'd like to trade these
you
things.
know, let's see. Let's see where the IWM's at. One sec. Yeah, see the IWM, it's not really doing a whole lot. It's got, it's in there. I think that it was expected. And I think that he can reverse and do sectoral tariffs. I think that when they went into this, Nutlick and those guys, I pronounced his name the wrong way intentionally, just so everyone knows. And they did it in a lazy way. This IEPA thing was a stretch. They did it because it was fast and broad reaching. I just think that in general, the whole tariff narrative that was anti-tariff, which was it's going to be inflationary, that's proved to be bullshit. It's been a strategic tool. I just think that tariffs, like, basically are actually not that bad for the U.S. I think what they're bad for is the fact that he usurped the rules, and so it's maybe a win to rein Trump in a little bit. I think that he's been kind of free balling there for a while, so maybe there's something that's positive about it in general to say, hey, he's not the king. But I don't know. I mean, I know that when I saw that Nutlick was his firm Cantor Fitzgerald was in the business of brokering these discounted tariff refund notes, that I was pretty sure that meant that he was going to get overruled on it. So, and I think that, to be honest, going back to April of last year, that the market kind of figured that out as well. So, it's 150 out of 350 roughly on an annualized basis. So you still got 200 billion of tariffs. He'll probably sectoral tariff 50 to, I don't know, arbitrarily I'll say 80, but could be a little higher. So maybe you're actually getting relief on 70 billion, 60 billion of tariffs. It's not that big a deal. Like, I think it's more of a signaling thing than anything else. But, the market's been pretty soft lately. So maybe that is somewhat of a benefit, but I don't think too much about it. I will say one thing, actually, because you talked about the prediction markets with, I don't know which one you were talking about, Kelshi or the other one, Polymarket. But there was a paper. There was a paper that came out of the Fed, from the New York Fed the other day, that actually showed that Kelshi was better at predicting Fed fund policy than the Fed fund futures or the SOFR futures, which, as you guys both know, I like to trade those. And one of the reasons why was because, Fed fund futures and SOFR futures are two of the most liquid markets in the world. A bank or some big, we're talking about big financial players, use that to hedge their risk, right? So there's a positioning component of it. But I thought it was interesting that it was the Fed basically corroborating that there's informational value to these prediction markets. Now, I don't really trade them. The only time I ever trade them, and if you go back in our show, I had proposed an arbitrage between the last presidential election of long Fannie Mae, long Geo, and then long Kamala futures and there was an arbitrage there, and it actually ended up working out because those Trump plays were convex. They were very Robert Marson-esque stocks where they made multiples of their money, and you're risking only a certain amount with the Kamala. But other than that, I mean, I think there is some informational value there, and I think that we're old, so it's easy to be like, oh, these little weird markets. But I think people should take a look at them, not necessarily as trading vehicles, but just from a new source of high frequency information. I just wanted to put that, and I didn't want to interrupt you before, Bob. Okay, I think that's it, guys. Let's bow tie this. Remember, buy ET. It's the best stock ever. Don't forget about the Schlumberger, and we'll see you next week. This is Wall Street Beats. I'm Ben Bry, Bob Morris, Robert Marson. Have a great weekend, guys. Enjoy the end of the Olympics in America.
I think when we do a show, you can call us Bobbert.
Bobbert,
guys.
yes. I'm going to steal that.
Thanks, guys.
Bobbert.
Bye.
All right, guys. Have a good weekend.